To build wealth and achieve financial success in the stock market, studying Peter Lynch's investment approach is crucial. What makes his strategy so appealing is its simplicity. You don't require a prestigious MBA from Harvard or a Wall Street data scientist's credentials from MIT to follow his teachings. Fortunately, Lynch generously shared all his investing wisdom in his books and countless interviews. From all his materials, I've distilled the 4 essential lessons that are must-knows for successful investing. I'd truly appreciate it if you could give this video a thumbs up and subscribe to the channel, as a lot of effort goes into creating these informative videos. Lynch firmly believes that anyone can become a successful investor, so stay tuned till the end to see how his principles come to life. Before we delve into the 4 investing lessons from Peter Lynch, it's essential to grasp Lesson 0. There's no such thing as a natural-born investor. Being great at investing is not determined by any family gene. Lynch's relatives, despite his success, were skeptical of the stock market due to their experiences during the Great Depression. Moreover, you don't need an exceptionally high IQ to adopt Lynch's strategy. Basic intelligence is enough to make money in the stock market. Peter Lynch, the legendary investor, had an unconventional background for someone working on Wall Street. Instead of studying business, finance, or mathematics, he pursued history, psychology, and philosophy during his college years. Although he attended Boston College, not the prestigious Ivy League schools, Lynch believes that his focus on history and philosophy actually prepared him to be a better stock investor, as he saw investing as more of an art than a science. This illustrates that successful investors can come from various walks of life, as Peter Lynch's story exemplifies. Now that you understand that you have what it takes to be an investor, let's take a deep dive into what you should know about investing. Lesson 1. Know your edge. The average individual investor possesses a unique knowledge advantage over professionals. While working for a large investment fund, my focus is limited to a certain number of stocks. On the other hand, individual investors have the liberty to concentrate on the stocks that Wall Street tends to overlook. Often, these overlooked companies are smaller in size, which keeps them off Wall Street's radar. In today's age, with readily accessible information on the internet, you can use your resources to find a list of these potential hidden gems. By utilizing stock screening tools, you can easily identify smaller companies that might offer great investment opportunities, ones that Wall Street might not even be aware of. Lesson 2. Knowing which stocks to avoid, perhaps even more crucial than identifying the right stocks to invest in, is the ability to steer clear of bad choices. Legendary investor Charlie Munger famously said, "I want to know where I'm going to pass away so I never go there." What he meant by this is that success often lies not just in doing everything perfectly, but also in avoiding costly mistakes. This principle holds especially true in the world of investing. Let's meet our friend John. He's determined to build wealth and has diligently saved $10,000 to invest in the stock market. One night, while browsing YouTube, John comes across a charismatic finance YouTuber who hypes up a particular stock as the next big thing, a can't-miss opportunity. Unfortunately, John lacks the knowledge to discern the credibility of such claims, as he hasn't watched educational Investor Center videos. In his enthusiasm, John invests his entire $10,000 into that one hype stock. However, the reality turns out to be quite harsh as the stock's value plummets drastically, losing 90% of its worth. Eventually, John is forced to sell at a significant loss. With a 90% decrease, John's $10,000 shrinks to just $1,000. Now, John faces the daunting task of recovering his initial investment. It's not as simple as finding another stock that will increase by 90%. Due to the steep decline, he actually needs a stock to grow by a factor of 10, which is no easy feat. This unfortunate example emphasizes the importance of being cautious about the stocks you choose to invest in. As Warren Buffett famously advises, there are 2 fundamental rules in investing. Rule number 1 is to never lose money, and rule number 2 is to never forget rule number 1. Peter Lynch identifies 3 types of stocks that should be avoided. Firstly, he advises steering clear of the next big thing hype, where stocks are touted as the next Amazon or some other major company. These stocks often trade at high valuations, making them vulnerable to significant losses in case of any setbacks. Secondly, Lynch cautions against companies that engage in diversification without sound reasons, especially when they acquire other firms at a premium. Such decisions may benefit the acquired company's shareholders, but they can be detrimental to the acquiring company's stock value. Lastly, investors should be cautious about companies heavily dependent on a small number of clients. Losing even one or two major customers can lead to serious trouble for the stock. Lesson 3. Do not sell winners too early. Many investors tend to sell their best performing stocks while buying more of the declining ones. A practice Lynch likens to watering the weeds and cutting the flowers. An illustrative example from my personal investment experience relates to Apple in late 2018. The stock had dropped over 30% due to concerns about slowing iPhone demand, prompting mass selling. However, taking a more long-term perspective, I believed in Apple's potential and valuation attractive. As a result, I made Apple a significant portion of my stock portfolio, acquiring shares at an average price of around $37, split-adjusted basis. In early 2020, I made the decision to organize my finances to buy a house. Consequently, I had to sell a portion of my stock portfolio in order to secure the down payment. Looking back, I realized I made a mistake following Peter Lynch's analogy by cutting my flowers instead of my weeds. Specifically, I sold my entire position in Apple, which had performed exceptionally well, at around $75 per share. Little did I know that the stock would continue to soar and reach approximately $180 per share, where it currently trades. This experience has sparked my interest in behavioral finance, which seeks to explain why people make certain financial decisions due to psychological biases that hinder optimal choices. One bias that stands out, especially when it comes to selling winners too early, is loss aversion. Loss aversion is the tendency for humans to dislike losses more than they appreciate equivalent gains. To illustrate this, imagine receiving an unexpected bonus of $1,000 from your employer. You'd undoubtedly be thrilled and walk around with an extra spring in your step. Now consider the opposite scenario. You were promised a $1,000 year-end bonus throughout the year. You've mentally spent that money, considering it already yours. But when you open your year-end paycheck, the bonus is missing and you're left with a sense of anger and disappointment. This example highlights how the emotional response to losing money is far stronger than the joy of gaining the same amount. This phenomenon also manifests in the world of investing. Upon reflecting on my decision to sell Apple, I recognized that I fell victim to loss aversion. I had witnessed the value of my shares more than double from the price I initially paid, and subconsciously I wanted to secure those gains before they could disappear due to market fluctuations. Lesson 4. Let your focus be the micro rather than the macro. Many investors tend to worry about the overall state of the economy, but they should shift their focus to specific companies and industries. In other words, don't get caught up in macroeconomics. Concentrate on microeconomics. Microeconomics delves into individual business decisions, while macroeconomics deals with the decisions of countries and governments. For instance, macroeconomics might ponder whether the economy will experience a recession this year, whereas microeconomics would explore the viability of investing in the auto industry. In the auto industry context, microeconomics would examine factors like the industry's future profitability, identifying potential winners, and assessing the impact of electric vehicles on its dynamics. Often, by employing microeconomic analysis, one can make informed and accurate predictions. In contrast, macroeconomics can be highly unpredictable. Even renowned economists are frequently wrong in their forecasts. As Warren Buffett humorously remarks, having an economist on the company's payroll might be unnecessary. Reliance on macroeconomic predictions when making investment decisions requires two correct predictions: what will happen in the economy and how the stock market will respond. Given the historical performance of economists, successfully achieving both predictions can be challenging. Furthermore, there's another less discussed aspect to consider. Not only must you accurately predict economic conditions, but you must also forecast the stock market's reaction. For instance, if we traveled back to early 2020 and accurately predicted the upcoming economic difficulties, it wouldn't guarantee successful investment choices. Despite the challenging economic times, the stock market may not react as anticipated. To truly profit from economic predictions, you must also accurately anticipate how the stock market will respond. If, for instance, you sold stocks early in 2020, expecting economic hardship, you would have likely incurred significant losses. Despite the challenges of that year, the S&P 500 actually surged by over 18%, illustrating the difficulty of basing investments solely on macroeconomic forecasts. Even if you correctly predict economic trends, making money on that call is far from guaranteed. On the other hand, focusing on the microeconomics of specific businesses and industries offers a more advantageous approach. Suppose you're deeply knowledgeable about a particular sector, such as the automotive industry, spending considerable time studying its trends and upcoming product launches. Your expertise grants you an edge over professional investors who lack such in-depth understanding. Numerous industries, from restaurants to fashion, video games to building materials, offer opportunities for individual investors to outperform professionals. By concentrating on the microeconomics of familiar industries rather than relying on macroeconomic predictions, you can gain a competitive advantage. There you have it, folks. Make sure to subscribe to the channel, as my goal is to enhance your investment skills by studying the strategies of the world's greatest investors. I'll be back with more insights soon.